I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is real estate expert Ross Kay from the wealthyhomeowner.ca. Welcome back to the show, Ross.
Hey, thanks for having me back, Jim.
Headlines say BC and Ontario led the nation's economic growth last year. Was that real estate? And does BC have anything to brag about this year?
Well, they're going to have lots to brag about. I guess it depends if you're in opposition or you're the one who is in power. I think if you go back in your archives, any of the listeners that are wondering, go back in the archives and they listen to my comments from early in 2016 when the comments were coming out about GDP growth in Canada and British Columbia, where the governments were patting themselves on the back because there was some more positive GDP growth. I think if you go back to those shows and you listen, you're going to hear me say that all of the GDP from November of 2015 through to around April or May of 2016 was driven solely by an increase in the housing market. So 100% of the GDP gains there could be accounted for by changes to the housing market. Now, I am not an economist, and I wouldn't pretend to be one, or for that matter, with what I've learned about how they comment about the housing market, I would never want to have my brand associated with being an economist. But what the economists have said, they're more skilled in that area than I am, non-homeownership, non-housing market commentary, was that there were other sources for excuses or causes for that GDP gain. When you're looking at it from our perspective, when we look at how those numbers are derived, the total impact on the homeownership market, on the economy, we knew that was 100% GDP, a result of GDP gain. 100% of those numbers from November of 2015 through till at least April of May of 2016. What you're having on BC now is you're not going to hear these first quarter numbers get reported in GDP for about another 2 to 3 months in British Columbia, because the way the real estate component of GDP lags it being reported in GDP. So real estate is unique as an asset class, and it's unique in its impact on GDP, that there is a natural delay. The delay is caused by the difference between the sale date of a property and the closing date of a property. Because the economic benefit of the sale of a home, which results in about, in British Columbia, you were over $90,000 of GDP for each home that was resale home that was being traded. Those benefits to the GDP don't come out until the home is closed. So you had a trailing decline, of course, since June of last year, June of 2016 in British Columbia, but it wasn't of enough magnitude that lenders weren't still lending on money on home equity lines of credit. People still weren't stopping buying houses. Renovation businesses started to slow down. The jobs that were a component of the renovations, the car sales, everything that's supported by higher house prices, that was only starting to impact British Columbia then in the fall of 2016. And the reality of your market as it exists today, that will be hitting home somewhere around, I guess, around July and August, just as your new government ends up taking power.
So how much home value has been lost under the Christy Clark government?
Well, at last count, last week's show, I think I mentioned that we know that there's already over $232 billion that will be recorded eventually as loss. But the way that everyone else measures a housing market, it takes a year, 18 months before them to realize what has actually happened to the market, because they don't have the metrics that we use. They don't measure the market the way that we do. We are a fact-based methodology in everything that we measure. So right now, you're going to be hearing tomorrow or the next day, as the real estate boards in British Columbia start to release, I know you're going to hear the benchmark price in Vancouver should be around about a 9% year-over-year gain. That is still reporting sales. The way the methodology works out in the production of a benchmark price, you're still months behind. You're still reporting prices way back on a annual basis from basically January. We know that Vancouver is full negative. So this is where the issue of how all these calculations come into play, and where the mess up and misdirection of the population takes place.
The home capital battle or debate, how bad is it, and do we have to worry about it?
Well, any historian out there, anybody who's had the hobby of studying history, or even what you're taught in school, will tell you. Actually, I go back really to that Christmas movie with about the run on the bank. Oh, James, what's that movie, Jim? Where if he wasn't there, the whole town falls apart. And Jimmy Stewart movie. Oh, can't even believe it's slipping the top of my head. Anyways, I go back to that movie, and they had a run on a bank. And that, I think he ended the day, he had $1 left or a couple of dollars left.
It's a Good Life or something like that?
Yeah, Wonderful Life.
A Wonderful Life.
Yeah. So, and it's crazy because it's a movie that we watch almost every Christmas in my family here. That said, that couple of dollars, that run on his bank is exactly what's happening with Home Capital Group right now. Now, I'm not saying that fear shouldn't dictate a rational response by an investor, someone who has their funds currently on being held at Home Capital Group. But you should also be a realist. You should also look at what facilities are in place to protect your income, or protect your any deposits that you have on file there. A run happens when it's just like the irrational exuberance claim in the United States, where people started to act irrational, paying too high of a housing prices, which happened in BC and is happening in Ontario now. But it also worked that way on the other side of the market, on the downswing. As the trading cycle starts to slow, this is what happens in the downswing. People panic. They make irrational decisions. There is, if you have $100,000 at Home Capital Group, and you're getting 4 or 5% interest on your money with them, you got to remember it's guaranteed by the government of Canada up to $100,000. Why you would pull that money out and lose that gain simply to put it in another bank where it's insured the exact same way, with the exact same insurance, with the exact same zero risk, unless the government collapses, it really doesn't make any sense. So you're seeing a run on HGC right now. Now, that's not saying that Mark Cahotes, the short seller from the United States, is wrong. He's actually right. He is saying that the company itself is really worth nothing because they have made some serious mistakes along the way. They have covered up for lies. They wanted to get a mortgage book. When you refer to a mortgage book, what I'm meaning to say is the amount of mortgages that a lender has is called their mortgage book. There could be 100 mortgages in it. There could be 100,000. There could be 1 million mortgages in that mortgage book. Home Capital Group's mortgage book is different than Home Capital Group, the company. Home Capital Group, the company, very well could disappear. The assets would be sold out. What the assets of Home Capital Group are is a mortgage portfolio. Clearly, when you have a government entity giving money to Home Capital Group, those people are not stupid. They're some of the best pension investors in the history of Canada. The stats show that out. So those people are fully aware what the value of the mortgage book is, and they know that some other lender at a discounted price will pick up that mortgage book. It could even be U.S. investors, by the way. It may not even be Canadian. And this is what this group understands. So they're going to take their quick 15% profit, which is the deal they negotiated, in fact, on $2 billion. And they're going to take that profit and run, and the pension plan will benefit from it. But for the person who has their money deposited at HGC and they have those great returns, if it's under $100,000, why would you take the money out? There's no need for that to happen. But you've got to run on HGC. That is probably going to have a cumulative effect or a compounding effect on decisions made on other third-party lenders, second-tier lenders, private lenders. In the public, we really risk a run taking place on those institutions as well. And this is where you've got to be very, very careful, and it's really where the government should be stepping forward, and Bill Morneau really should be leading this file right now, in my opinion, by telling everybody, look, guys, we have CDIC insurance on your $100,000 that's deposited there. You're going to get that return. That money's insured. There's no need for you to pull those funds out. But he's remaining silent instead, because
Bill Morneau did say he was happy to see a private market solution to Home Capital's problems.
Right, and that to me was really code when he released that today, Jim. I think what he was really saying is, okay, I know that the pension plan, worst case scenario, will probably take over their mortgage book if necessary, and they'll unwind that mortgage book portfolio, reaping as much profits from it as they can. So he's off the hook in terms of the federal government having to step in and artificially support Home Capital Group's exit from the market. Well, what he didn't say is what the shareholders should be worried about, because he wasn't referencing Home Capital Group at all. As far as our firm is concerned, his reference was specifically to their book of mortgages and their book of mortgages alone, because Bill Morneau realizes now that the government of Canada is not going to be the one that needs to reach out a financial hand to secure that portfolio.
Home Capital Group, Equitable Bank, and others offer mortgages to Canadians not able to secure them through traditional lenders. What hurdles do these Canadians now face, and what do you suggest as a solution? Yeah,
well, this is another problem when you have fear gripping a nation, and in this case, we're talking about alternative lenders, shareholders, or deposit holders. It's fear of loss of money, but those lending facilities, those third-party lenders, alternative lenders, they are a needed component in the home ownership market. There are business people who get into trouble, who realize that if they can stay afloat for the next year and a half, they have revenues that are going to be incoming that will offset this short period of difficulty that they're going through. This also flows to their own personal residences. A lot of entrepreneurs, a lot of business people run into these situations. This is where an alternative lender, it works out awesome. They realize, as Home Capital Group does, that even though the people may not be qualified on bank standards to be assured of being able to having the ability of repaying the loans on their monthly payments, they also realize, Home Capital Group or these other alternative lenders, that the value of the real estate that backs the mortgages they're lending more than offsets not only the interest that they're expecting to gain, but also any costs that they would incur to liquidate their real estate to recoup their profits. So these lenders lend money on loan-to-value ratios that have enough room, even at origination, that they're going to be okay. After a year or two, often these loans are renewed, and often they go back to a traditional lender at that time because that's where they get a lower interest rate. Instead of paying the premiums you have to pay to get alternative lenders. But if our country was not to have this available, so if there was not a Home Capital Group, an equitable bank. Now, again, for the wealthy homeowner members, we tell people, you have to understand this is the interest rate you're paying. This is the consequence if you use one of these lenders. Just be aware of what you're doing. That's all that we're saying. Don't go in blind. But because these businesses serve a useful purpose. They allow entrepreneurs or people in short-term difficulty to weather that storm without having to sell their home and move their family. You've got to remember, when you move a family, there's a minimum 8 months where the business profitability, if you're an independent business person, drops. And that's a short-term 8 months. Many people, it's a year and a half before you're fully recovered from a change of households if you're an entrepreneur. So it's way more effective for the economy to have these places operating, even if they make a little bit higher profit. If those are no longer available, so let's say that Home Capital Group has 60,000 mortgages. Let's say, for the sake of the argument, Home Capital Group goes to nothing and their book of mortgages is sold off. Let's say the mortgage pension plan or the pension plan that bought that lent them the mortgage money to get the 15% gain, takes the book of mortgages as collateral to regain the money that they had invested. They are going to gradually get rid of that portfolio. What's going to happen, though, is if the entrepreneur or the business person or the person in difficulty has not improved their financial situation since the time they were not forced, but their only alternative was to go to a Home Capital Group type company, those people will be forced with selling their home. So now it gets dicey, because what happens if 3/4 of 60,000 homeowners could not refinance at a traditional bank? Those people are forced with having to sell their home. If those homes are added to a marketplace where the market is already correcting, the speed and the volatility of the declining market, the correction, and the volatility of the market increases. And that's where your added risk for that is. So we really need that. Now, what was the second part you asked? Did you ask me about what are our alternatives?
Yes.
Okay, so the alternatives, a lot of the confusion that exists over this bank of mom and dad is because somehow the old practice of private mortgages has been forgotten by our society. Really one of the most foolish things that happens right now, it's where a mother and father have investments. And those investments, in order to get a 5-6% return, have to have a moderately higher degree of risk for someone who would be 65, 70 years old should be assuming. Yet their kids have mortgages at a bank where the bank has lended them the money. Now, really what should be done is the mother and father really should be the bank of mom and dad, and they could go ahead and lend that money through a lawyer and a mortgage broker. So in other words, they're not really the ones that have control over if the kids don't make the payments. They're not going to be the ones that have to say, hey, you got to pay us. It's going to be lawyers and a mortgage broker acting as an independent third party. But they should be lending those funds, because you can maybe lend your kids the money at 3.5% for 2 to 3 years instead of your kids paying CMHC insurance. Well, with that CMHC insurance off of the mortgage, not only do you save CMHC insurance, GST, HST on the CMHC insurance, any additional interest rate gain you would have to face because you had to take a mortgage with CMHC insurance, but also that isn't added to your mortgage and amortized over 25 years. A simple calculation, sitting down with a mortgage broker, an accountant, and your lawyer can allow the bank of mom and dad maybe to fund part of that mortgage or all of it, and from the bank of mom and dad to reap the rewards that the banks are already doing. As long as mom and dad aren't on the hook, should the kids not make their mortgage payment, we're okay. And there are ways for that to take place. As a matter of fact, we have a strategy for people in that place, in that situation for our millennial home buyer program, where the parents want to participate, that allows that security to take place.
We'll have more with Ross Kay right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Ross Kay. Ross, Vancouver releases their monthly stats this week. What do you expect to see, and how should our listeners interpret what they read in their news releases?
What you got to remember is they're stats, they're not data. What you got to remember is we are expecting, so you're going to hear right here today, somewhere around a 9% year-over-year gain in their benchmark price. Maybe they can squeeze it to 10.5, but it's going to be right around that 9.5 points. That's really reflecting the market back from January, not today. Vancouver is full negative. Remember last week's show, I mentioned BC was full negative? Well, your provincial market moves ahead of your supermarket in the province that it exists. And what's happened here is Vancouver is simply only rolling over 1 month later than you did in the province. So your housing prices are falling. You're going to hear a little bit of it this month when you hear, the year-over-year gain has dropped to 9%. But what you're going to hear over the next 2 months is a radical drop to negative, where year-over-year gains that we're recording as of this morning for Vancouver are minus $346 year-over-year. That means the average home buyer who purchased a year ago now is fully negative. They've lost money.
Are real estate investors treating low money down condo pre-sales like an option play on the real estate market? And what could this mean to the overall housing market? Okay, so I'm going to say this is simple. You've got a 2 to 5 year lag on these pre-sale condos before they're closed. You may have people who are stupid enough to count on a housing market
that's been on a upward swing in a trading cycle in Ontario here to continue on. Or in Vancouver, a trading cycle that is already on the downswing, you're thinking it's going to bottom and start to go back up by the time your condo is built and you're closed on it. There may be people who, I'm going to use this word carefully, are stupid enough to make that financial decision. I would think that in this stage now is what you're seeing is pre-sale condos from sales that took place 2 and 5 years ago are now coming to fruition in terms of their closing date. Those properties, with all the gains that have been accumulated over the last 2 to 5 years, will come to market. That's what adds fuel to a correction. And that's really what you're talking about here. So I don't believe people are still walking into the pre-sale markets. Certainly not in BC, they're not. Our data shows that they're not. They're not walking to the BC market thinking that they're going to make gains so they can flip. And even in Ontario here, we're not seeing new money coming into the marketplace that would indicate any expectation that 2 to 5 years from now, the current housing market was going to stay on its same path, and in order to allow people to reap these 15 to 20% increases that the banks and everyone else is telling them housing prices are going up.
We'll have more with Ross Kay right after this.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Ross Kay. Ross, if people are putting down these pre-sale option plays, what would the ramifications be for investors if they're Canadian or if they're foreigners?
Well, to be quite honest with you, my concern is never the investor, whether they're foreign or Canadian. My concern is for the regular Canadian family, the 11 million Canadian homeowners that I would like to see have financial success in their lifetime through home ownership. So I'm not gonna really answer your question in terms of what will happen to those investors. I'm going to answer the question is what can happen to your overall housing market. Investors who purchased a property 2 to 5 years ago purchased at prices tens of thousands or hundreds of thousands of dollars less than what they can could be listing the property for today when it's finally built. That means that for the investor, even if they took a 50% cut on their profits, they're still getting a huge windfall. And remember, with capital gains tax, 50% of that profit is already taxed. So really it's only a 25% loss of that spread that we're talking about. So the investor still comes out ahead. He just gets it on the market, or she gets it on the market and sells it. What happens though is the regular people who purchased in that building or in a neighboring building, which its own prices have gone up, watching as the new build's prices went up, because it's a cheaper alternative, the older building, those people cannot take that same hit to their net wealth. They're believing that their condo has gone up 25% in the last 4 years, and they're counting on that 25% gain. So what you'll see is once you start to see these investment units come to the market, because the investors don't want to hold the property, they realize the rents are not going to break. They're not going to break even with the rent they're going to get. So they want to liquidate the asset as quickly as possible and reap as much gain as possible. It's again a compounding effect. It's the market that starts to go the other way. Fear sets in, more units come into the market, and prices start to tumble even further. This is a stage 3 of a house price correction. So in British Columbia, as we've told you before on the show, you are now already into stage 2. Stage 3 is that when the panic sets in from investors of newly constructed units that are closing. And that's when your price drop really starts to take hold. You've heard a lot of words in the last couple months in British Columbia about condo prices still going up and that the ultra-luxury class is dropping. If you're not using the right metrics to measure the market, whether you're an investor or a homeowner, so you're not tracking the market the way that it's actually functioning, you are not going to be prepared for what happens if those investment condos hit the market. The losses that you're going to take will be substantial. The reason we created a lot of our own metrics were to allow people independently to look at their prices, look at their equity, protect themselves. That's where the risk is. It's not for the investor. It's for the regular old homeowner who innocently is a bystander who's benefited for price gains and now will watch their net wealth take a hit.
Many of our listeners are what are called millennial home buyers who are often comparing their home search with that of their parents. How do you counsel these first-time buyers, and what do you see happening with home prices over their lifetime?
Okay, so home prices for the millennial home buyer will not be rising as rapidly or as quickly as their parents did. So their parents have owned a house for 30 years. The next 30 years going forward, we will not see housing prices appreciate at that same level. There's multiple reasons, factual-based, infrastructure-based, how a housing market functions based, that means that is a technical impossibility. The only way it wouldn't happen if buildings stopped and we kept a whole bunch of people kept immigrating to Canada, which we know that's not going to happen. So the gains we're looking for over the next 30 years are the same gains that we should have been expecting the previous 30 years. They are simply a function of the market. So the millennial home buyer, what they need to do is they need to step back and structure their home ownership situation totally different than how their parents did it. Because the millennial home buyer will be faced with a rising interest rate cycle, probably for the next 30 years that they own their home. That means your strategy for home ownership must change. But I also want to let the millennial listener here on the show understand this. This talk of risk of foreclosure for the millennial as interest rates rise is a myth. The home ownership math that supports prudent home ownership shows you that you have zero risk of losing your house on rising interest rates. We did a model over the weekend, Jim, that took interest rates from 4.2%, a millennial buying a house at 4.2% today, rising to 4.8% 5 years from now, to 8.2% another 5 years from now, to 14% 15 years from now, and staying at 14% until the mortgage is paid off. Those millennials' mortgage payment in real dollars never has to change. The only risk anyone in Canada has over foreclosure, even going from 2.4% interest rate to 14% 25 years from now, is job loss. That's the only risk that's out there. And if you have fear of job loss, then you must structure your home ownership situation in a unique manner. You need the strategy that allows that to happen.
And what kind of a strategy is that?
Well, again, this is self-serving. The wealthy homeowner strategy for people in that situation, it's a whole different set of variables that you make your decision on. So not only is the price point that you choose different than if you have a secure job, not only is the mortgage that you choose different than if you have a secure job, not only is the mortgage payment that you make different than if you have a secure job, but all of the paperwork that you did to let all that happen is different than if you had a secure job. No two home buyers are the same. This is the thing I hate most about these home buying guides, home buying instructions, home buying videos, the bank telling you how to buy a house, realtors telling you to buy a house. I have never met, of the hundreds and hundreds of first-time buyers that I sold houses to while I was a realtor, I never met two that were the same. Not two sets of buyers were ever the same. They were all unique. They had to fine-tune their strategy a little tiny bit for each of those hundreds of different people. Generally speaking, you can go with a set of strategies that's common. But if you're worried about losing your job, then you have to add in a risk avoidance strategy, which, it's too complicated to discuss here, but it's not really complicated. It's just the back end that supports the strategy from why it's needed. There's so much knowledge and research that had to go into that. Unless you've studied the housing market for 30 or 40 years, you would never understand what protections you can put in place so you never have to worry about losing your home.
Well, as you said, job loss. So in other words, if you work in radio and TV, don't plan on getting a mortgage because we lose our jobs.
Well, or you may get a mortgage, Jim.
Yes.
But you may also get job loss insurance.
Yes.
Which will cover your mortgage for 2 years, if you lose your job. You may structure your mortgage on in the early years on a 17-year amortization, even though it's a 25-year amortization mortgage. You just simply accelerate your payments, but that gives you the flexibility of dropping your mortgage back. You see, this is why we always say at our monthly membership fee at the Wealthy Homeowners is $19. It's fully refunded. The reason we know it's never going to have to be refunded is there's so much intelligence that we market strategy programs that we give people, it's impossible not to save $19 a month. This one little strategy I'm telling you about with job loss, we're talking tens of thousands or hundreds of thousands of dollars in savings that people technically could find themselves benefiting from. That's where the strategy comes into play. That's what's reviewing, 5,000 home ownership experiences is about, and 100,000 years of cumulative homeowner knowledge results in.
Well, Ross, I guess that's why it's always a good idea to talk to an expert like you.
Yeah, I just wish there was more people out there that I could recommend that you talk to. Luckily, we've got the online portal now that intelligence can be delivered there, and then the strategist can sit there and handle lots of people at once, giving this prudent and fact-based home ownership advice, along with even whether or not you should buy at any given moment in time.
Ross, thank you so much for chatting with us.
Hey, Jim, I really appreciate talking to you again.
My guest has been real estate expert Ross Kay from thewealthyhomeowner.ca. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Questions for the show or for Ross can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.